Most traders believe consistency comes from finding the right strategy, the perfect setup, or the next indicator that finally makes everything click. But that belief alone is the reason consistency feels so far away. Consistent traders don't see the market the way everyone else does. They're not smarter, they don't predict better, and they're not emotionally stronger by accident. They think differently. While the average trader is obsessed with being right, consistent traders are focused on being aligned with probabilities. While most traders react to every tick, consistent traders operate from a mindset that's already made peace with uncertainty. And while most traders allow results to define who they are, consistent traders have separated their identity from the outcome of any single trade. This difference in thinking isn't subtle, it's foundational. And until your thinking changes, your results never will. Most traders believe they accept uncertainty, but what they really accept is the idea of uncertainty, not the emotional reality of it. They say anything can happen, yet the moment price moves against them, their behavior reveals the truth. They hesitate, interfere, second guess, or panic. This isn't a lack of knowledge, it's a lack of acceptance. And until uncertainty is fully accepted at the deepest level, consistency will always remain out of reach. The market is an environment where outcomes are inherently uncertain. Every trade exists within a probability distribution, not a guarantee. This is not a philosophical concept. It is a practical truth that governs every price movement. Consistent traders don't fight this reality. They align with it. They understand that uncertainty is not an obstacle to success. It is the very condition that makes trading possible. Without uncertainty, there would be no opportunity, no edge, and no profits to extract. Inconsistent traders are unconsciously trying to eliminate uncertainty. They want reassurance before entering. They want confirmation after entering. They want the market to behave in a way that validates their decision. When the market fails to do so, fear emerges. Not because money is at risk, but because their belief system has been violated. They believe that analysis should lead to certainty, and when it doesn't, the mind reacts defensively. Consistent traders operate from a different belief structure. They no longer expect certainty from the market. Instead, they expect randomness within a known framework of probabilities. This shift is subtle, but its impact is profound. When uncertainty is accepted, there is no emotional shock when price behaves unexpectedly. Nothing has gone wrong. Nothing needs to be fixed. The trade is simply doing what trades do, expressing a probability. Acceptance of uncertainty begins before the trade is ever placed. Consistent traders have already made peace with the worst-case scenario. They have already defined their risk and accepted it as the cost of participation. Because of this, there is nothing left to protect once the trade is live. No emotional defense is required. No impulsive decisions are triggered. The mind remains clear because it is not trying to avoid pain, it has already accepted it. This is where most traders misunderstand risk. They think managing risk is about position sizing or stop placement. In reality, true risk management happens internally. It is the moment you accept fully and without resistance that this trade can lose and that the loss will not damage your self-image, your confidence, or your future. Until that acceptance occurs, fear will always find a way to express itself through your behavior. Fear does not come from losing money. Fear comes from being emotionally unprepared for loss. When a trader has not accepted uncertainty, every tick against their position feels threatening. The mind begins searching for ways to escape discomfort. This is when traders move stops, exit early, add impulsively, or hesitate on the next signal. These actions are not strategic errors, they are emotional reflexes. Consistent traders experience the same uncertainty, but they don't personalize it. They do not interpret adverse movement as a reflection of their intelligence or skill. The market is not punishing them. It is not testing them. It is simply unfolding. This neutral interpretation allows them to stay present and objective, even when outcomes are unfavorable. The irony is that the more a trader tries to avoid uncertainty, the more chaos they experience. Control becomes the obsession. Control over outcomes, control over emotions, control over the market itself. But the market cannot be controlled, and every attempt to do so increases psychological tension. Consistent traders relinquish control where control does not exist, and in doing so, they gain control where it actually matters over their decisions. Accepting uncertainty also frees traders from the need to be right. The need to be right is one of the most destructive forces in trading psychology. It ties ego to outcome and turns every trade into a personal judgment. Consistent traders don't trade to prove anything. They trade to execute an edge. Being wrong is not a problem, it is expected. Losses are not mistakes, they are confirmations that uncertainty is functioning as it should. When uncertainty is accepted, patience emerges naturally. There is no rush to enter marginal trades because there is no anxiety about missing out. There is no urgency to recover losses because losses were already anticipated. The trader waits for conditions that align with their plan, not because they are disciplined by force, but because there is no emotional pressure pushing them to act prematurely. This acceptance also stabilizes confidence. Inconsistent traders confuse confidence with winning. When they win, they feel confident. When they lose, confidence collapses. Consistent traders derive confidence from process, not outcome. Their confidence comes from knowing they can execute correctly regardless of what the market delivers. This type of confidence is immune to short-term randomness. Another critical consequence of accepting uncertainty is emotional neutrality. Emotional neutrality does not mean the absence of emotion. It means emotions are no longer in control. The trader may notice disappointment, excitement, or frustration, but these feelings do not dictate behavior. Decisions are made from rules, not reactions. This state is impossible to achieve without first accepting that outcomes are uncontrollable. Many traders believe they need more self-control. What they really need is a belief system that does not generate emotional conflict. You cannot override fear consistently with willpower. Fear disappears when the belief that causes it is dissolved. When you no longer expect certainty from an uncertain environment, there is nothing to fear. Consistent traders have internalized one fundamental truth: the market does not know they exist. It does not reward, punish, approve, or disapprove. Once this truth is fully accepted, trading becomes impersonal. And when trading becomes impersonal, execution becomes effortless. This is why consistent traders appear calm under pressure. They are not suppressing emotions. They are not trying to be disciplined. They are simply aligned with reality. Their expectations match the environment they are operating in. There is no internal conflict between what they want and what the market can provide. In the end, accepting uncertainty is not a technique. It is an identity shift. You stop seeing yourself as someone who needs to predict and start seeing yourself as someone who executes probabilities. You stop demanding certainty and start respecting randomness. And when that shift occurs, consistency is no longer something you chase. It becomes a natural byproduct of how you think. The market never changes. The uncertainty is always there. The only question is whether you are still fighting it or finally trading in harmony with it. Most traders approach the market as if every single trade is a verdict on their ability. One win means they're doing something right. One loss means something is wrong. This mindset turns trading into an emotional roller coaster because individual outcomes are random, even when an edge is present. Consistent traders have stepped out of this trap. They no longer think in terms of individual trades. They think in probabilities. The moment a trader becomes emotionally attached to the outcome of a single trade, objectivity disappears. The mind begins to seek certainty where none exists. Every tick is interpreted as information, every fluctuation as a signal. This is not analysis, it is fear looking for reassurance. Consistent traders understand that no individual trade has meaning by itself. Its only purpose is to be one occurrence within a larger statistical series. An edge in trading does not guarantee wins on any given trade. It only guarantees a favorable outcome over a sufficiently large sample size. This is not theory, it is how probability works. Consistent traders have accepted this at a deep level. Because of that, they are not surprised by losses, even when they execute perfectly. Losses are not evidence of failure, they are evidence that randomness is functioning normally. Inconsistent traders evaluate themselves after every trade. They ask, was this a good trade? And the answer depends entirely on the outcome. This creates a distorted feedback loop. Good decisions that lose money are labeled as mistakes, and bad decisions that make money are rewarded. Over time, this reinforces destructive behavior. Consistent traders break this loop by separating decision quality from outcome entirely. When you think in probabilities, your focus shifts from winning to executing. The question is no longer, will this trade work? But did I follow my rules? This shift removes emotional pressure. You are no longer trying to extract certainty from the market. You are simply participating in a process that unfolds over time. Most traders underestimate how much damage the focus on individual trades causes. After a loss, they feel the need to recover. After a win, they feel invincible. Both states distort perception. The trader is no longer seeing the market as it is, but through the lens of their last result. Consistent traders remain grounded because their reference point is the series, not the last trade. Thinking probabilistically also eliminates the fear of pulling the trigger. When you believe each trade matters too much, hesitation becomes inevitable. You want the perfect entry, the perfect confirmation, the perfect moment. But perfection does not exist in a probabilistic environment. Consistent traders take valid signals without hesitation because they know the outcome of this trade does not define anything. It is simply one of many. This mindset also prevents overconfidence. A string of wins does not mean the trader has suddenly mastered the market. It means variance is currently favorable. Consistent traders do not increase risk impulsively after wins because they understand that probabilities have not changed. Their edge is the same. The distribution is the same. Only the short-term outcome sequence has shifted. The same logic applies to losing streaks. Inconsistent traders see a series of losses as proof that something is broken. Doubt creeps in. They abandon their plan, adjust rules emotionally, or stop trading altogether. Consistent traders recognize that losing streaks are a natural part of probability distributions. As long as the edge and execution remain intact, there is no reason to change behavior. This is why record keeping and sample size matter so much. Consistent traders measure performance over dozens or hundreds of trades, not a handful. They understand that meaningful data requires volume. One trade is noise. 10 trades are still noise. Only over time does clarity emerge. This long-term perspective stabilizes emotions and reinforces discipline without force. Thinking in probabilities also removes the need for prediction. Most traders believe they need to know what the market will do next. Consistent traders know this is impossible. They don't predict, they prepare. They define scenarios, manage risk, and let the market reveal itself. Their job is not to forecast the next move, but to respond appropriately when their edge appears. This approach creates emotional resilience. When a trade loses, there is no shock. The outcome was already accounted for mentally. When a trade wins, there is no euphoria. The outcome was never the goal. Emotional extremes disappear because expectations are realistic and aligned with probability. One of the most powerful effects of probabilistic thinking is the disappearance of revenge trading. Revenge trading is fueled by the belief that the last trade matters too much. The trader feels wronged and needs to correct it immediately. Consistent traders don't feel wronged by the market. Nothing has been taken from them unfairly. Losses were expected. There is nothing to avenge. Over time, this mindset transforms confidence. Confidence is no longer based on recent results, but on trust in the process. The trader knows that if they continue to execute correctly, the numbers will take care of themselves. This trust cannot be shaken by short-term randomness. Ultimately, thinking in probabilities is a shift from an outcome-based identity to a process-based identity. You stop seeing yourself as someone who wins or loses and start seeing yourself as someone who executes. This is not an intellectual shift, it is a psychological one. It changes how you experience every moment in the market. The market does not reward effort, intelligence, or emotion. It rewards alignment with how it actually functions. Consistent traders have accepted that reality. By thinking in probabilities instead of individual trades, they free themselves from emotional chaos and allow consistency to emerge naturally. In the end, the paradox is simple: the less importance you place on any single trade, the more consistent your results become. Most traders don't realize that they are not just trading the market, they are trading their self-image. Every win feels like validation. Every loss feels like rejection. Over time, the account balance becomes a scoreboard for personal worth, intelligence, and capability. This is where consistency quietly breaks down, not because of strategy, but because identity has been tied to outcomes that are inherently uncontrollable. Consistent traders have broken this connection. They no longer allow the market to define who they are. A winning trade does not make them smarter, and a losing trade does not make them flawed. Results are information, not judgment. This separation is not emotional detachment, it is psychological clarity. When self-worth is tied to results, fear becomes unavoidable. A loss is no longer just a financial event, it becomes a threat to identity. The mind goes into protection mode. Traders hesitate to enter, avoid valid setups, move stops, or exit early, not because they lack discipline, but because they are subconsciously trying to protect how they feel about themselves. Consistent traders are not immune to emotion, but emotion no longer dictates behavior. They have accepted a critical truth: the market does not measure personal value. It does not know who you are, what you want, or how hard you try. Once this truth is internalized, losses lose their emotional sting. They are expected, accounted for, and emotionally neutral. Inconsistent traders often seek confidence from winning. This creates a fragile form of confidence that collapses the moment a loss appears. Consistent traders derive confidence from execution. Their self-assessment is based on one question only: did I follow my plan exactly as designed? If the answer is yes, the trade is a success regardless of the outcome. This shift removes the need for emotional recovery. After a loss, many traders feel the urge to get it back. This urge is not about money, it is about restoring damaged self-image. Consistent traders do not experience this compulsion because nothing has been taken from them psychologically. Their identity remains intact. Separating self-worth from results also eliminates overconfidence. When traders identify with winning, a streak of success creates ego inflation. Risk increases, rules bend, discipline erodes. Consistent traders avoid this trap because wins do not enhance their sense of self. A win is just a trade that expressed probability in their favor. This mindset allows for honest self-reflection. When identity is protected, feedback can be evaluated objectively. Inconsistent traders avoid reviewing mistakes because mistakes feel personal. Consistent traders review with curiosity, not judgment. Errors become data, not evidence of incompetence. Another critical benefit of this separation is emotional endurance. Trading is a long-term endeavor filled with drawdowns, plateaus, and randomness. Traders who tie identity to results burn out. Consistent traders endure because their sense of self is stable. They can experience extended periods of underperformance without losing confidence or abandoning their process. This psychological independence also improves decision-making under pressure. When a trader is emotionally invested in being right, pressure increases at key moments. Execution becomes tense. Consistent traders feel less pressure because there is nothing at stake psychologically beyond following the plan. The outcome no longer carries emotional weight. Many traders believe they need stronger discipline to stop emotional behavior. What they actually need is to stop seeking emotional validation from the market. Discipline becomes effortless when there is no internal conflict. You don't need to force yourself to follow rules when breaking them doesn't serve any emotional purpose. Separating self-worth from results also changes how traders experience success. Success is no longer a dopamine spike tied to profit. It becomes a quiet confidence in process. This stability prevents emotional exhaustion and keeps performance sustainable over time. This mindset requires responsibility without self-punishment. Consistent traders fully own their actions, but they do not attack themselves for outcomes they cannot control. They distinguish between controllable behaviors and uncontrollable results. Only behavior is evaluated. Results are observed. Ultimately, this separation is what allows traders to grow. When ego is not involved, learning accelerates. There is no need to defend past decisions or justify mistakes. Every trade becomes an opportunity to refine execution, not a referendum on self-worth. Consistency does not come from emotional toughness. It comes from emotional neutrality. When your identity is no longer on the line, the market loses its power to manipulate you psychologically. In the end, the most consistent traders are not those who win the most. They are those who remain psychologically intact regardless of what the market does. When self-worth is separated from results, trading becomes a profession, not a personal battle. And that is when consistency finally becomes sustainable. Consistency in trading is not the result of better predictions or stronger discipline. It is the result of a transformed mindset. When you accept uncertainty, think in probabilities, and separate your self-worth from results, the emotional chaos disappears. Trading becomes impersonal, structured, and repeatable. The market no longer controls how you feel or how you act. You do, and when your thinking aligns with how the market truly works, consistency stops being something you chase and becomes a natural outcome of who you are as a trader.